I think it's now 11:05. We can start. So, good morning to you, everyone. Once again, my name is Emmanuel Zapasi, and I am the Audit and Advisory Manager at Elchad Chartered Accountants. I would like to welcome you to our webinar today, where we will go into detail with IFRS 18, that is presentation and disclosure. Introducing the first speaker. Our first speaker is our Managing Director for Elchad Business School, as well as our Managing Partner for Elchad Chartered Accountants. He is a Chartered Accountant and a Registered Public Auditor with a vast experience in IFRS as well as IFRS. Over to you, Ellis.
Arnold, can you hear me?
Yes, we can hear you.
Okay, that's fine. Well, thank you very much. Good morning, everyone. Extremely excited to be here for this webinar where we're going to be talking about IFRS 18. I think just before I get in, I just want to make sure from the team that I'm loud and clear. Whilst at the same time, I'm sharing my screen. Okay, right. Right, Emmanuel, just confirm if I'm very audible, whether you can hear me clearly.
Yes, we can hear you clearly.
Okay, no, that's fine. No, thank you very much. Once again, thank you everyone who has been able to join on this webinar, which I believe is very important in equipping. One of the things that at Elchad we are committed to do in terms of equipping accountants and finance managers and people in the finance function, particularly around reporting. So I'm just going to go through a presentation, just bringing to you IFRS 18, which is obviously one of the latest standards that has been issued by the ISB, covering the presentation and disclosure in financial statements. So we all are aware that currently IS 1 dealt with the issues to everything to do with presentation and disclosure in financial statements, and will be replaced by IFRS 18. So this change, the nature of IS 1 itself was that it cut across because it's providing principles around how you present your financial statements and how you do disclosures in your financial statements, which means it was pervasive, cutting across all standards, having an impact across financial reporting in a very pervasive way. So what that means is with the coming in of IFRS 18, the impact is also going to be pervasive. It's unlike you're dealing with a standard that just covers one particular issue. In this case, you're dealing with a standard that's going to affect the way we present our entire set of financial statements. So I'm just going to go through a summary presentation here where I just go through some of the key changes that you're likely to see being brought about by IFRS 18. And like what Emmanuel said, we'll then have an opportunity for a Q&A at the end, and then we'll also talk about what other ways we can also support you in this. As introduced, my name is Ellis Mukunyadze. I'm a chartered accountant by training and also a registered public auditor. I'm the managing director of Elchad Business School, as well as Elchad Chartered Accountants. At some point during the presentation, someone is going to come and really tell you a little bit more about who Elchad Business School is and who Elchad Chartered Accountants is and how we can work with you and how we can support what you're doing. I'm an expert in both IFRS as well as IFRS standards. So just going into now the presentation. In terms of the objectives of what it is that I would like to cover in this short time that we have together is to help you guys understand the scope and the purpose of IFRS 18, and also appreciate what are some of the key changes that you would expect as you navigate or as you transition from IS1 to IFRS 18. I'll go into detail in terms of the structure and the content requirements under IFRS 18, including the disclosures of management performance measures and also the transitioning as well as the effective date. So these are the main objectives for this webinar. So the standard IFRS 18 was issued last year in April of 2024. And like I said earlier, it's replacing IS1, which dealt with the presentation of financial statements. So the standard is the main thrust is really where the biggest changes you see as we're going to present is the changes that you see around the statement of profit and loss structure. So that's where the fundamental change is. And also the introduction of management and defined performance measures, as well as also then clarifying certain disclosure principles to make financial statements better and easy to understand by the different users of those financial statements. So in terms of effective date, so it's effective from 1 January 2027. However, early application early application is obviously permitted, and we always encourage people that if we're able to do early application, let's do early application. So during the transition period, during transition, comparative information would be required. Essentially means that although the effective period is 1 January 2027, but essentially what we are saying is that when you then do your comparison, which means you then need to show comparative information which is aligned to the new presentation. And so in our comparative year for 2027 will be 2026. So whilst we're talking about that, and people still think, I know we've got time because it's effective in January of 2027. But the point that I want to try and make here as we start is that you need to think about 2026 already. And the moment you're thinking about 2026, you need to think about the opening balances for 2020 and for 2026, because these are the ones that inform your balances, your presentation for 2026, which will be a comparative year as you present 2027. So in my view, that it's important that we already start in terms of working on the standards, in terms of implementation, as soon as possible. There's going to be a lot of work that is required, and one of the things is really going back even to your chart of accounts, seeing how you remap your chart of accounts to the required presentation. And I think that's where the work is. Whilst the expectation, as you see going forward, is that whilst the numbers really remain the same, but it's the way the numbers are presented, is the way the numbers, what the numbers tries to communicate, which is the essence of financial statements. What are we communicate? What are we trying to communicate, and how are we communicating that? That becomes the most important things when we are presenting financial statements. So in terms of the work that we need to do, we need to do the work much, much earlier and make sure that we are quickly getting on board with the standard. So in terms of the objective, of IFRS 18, it goes back to what is the objective of financial statements. Financial statements should be able to provide relevant and faithfully representative information. So it's all about communicating, and financial statements is the primary tool that we use to communicate with the users of financial statements. So people must understand the information that is being communicated by the financial statements. People must be able to use that information for decision making. But over and above that, must be able to compare. They must be able to see through into the business and also help assess the future cash flows and management stewardship. When you invest in a company, one of the things that you're investing is you're looking at what is the prospects of this company going into the future. So, and the primary tool you have to be able to do that is the financial statements. Will I get a dividend? Will I get an increase in my return? Is management doing a good job? That's what. So the objectives around even the whole change around this particular standard is to make sure that we're able to communicate better to the different users of financial statements when we prepare these financial statements. So in terms of scope, it obviously it applies to general purpose financial statements, which are really the financial statements you're publishing for general purpose use. It would be good to align the same, for example, for your management reporting. Management reporting are specific purpose financial statements because they're internal, they're for the board. But so that's not going to be covered by IFRS 18. IFRS 18 talks to your reporting to external stakeholders, to your users of financial statements. But like I said, it's always good to align so that you're doing the same thing internally and externally. It excludes financial statements under S34 with some exceptions. And generally, as IFRS, it's really targeted more at profit-oriented entities. So if you're coming from an organization where profit is not the main motive, you must therefore be willing to make certain maybe adjustments or present things slightly differently to be able to meet the objectives of the users of your financial statements. And it allows the terminology to be adjusted for specific needs. So whilst there is recommended terminology to use, for example, for the statement of financial position, but people can still use things like balance sheet. They're still fine. There are different terms that entities can use. The standard is not very prescriptive or doesn't make it mandatory to use the same terms when you're describing the elements in the financial statements. Right. So as a starting point, as we go into the standard in much depth, you see that there hasn't been much of a change in terms of what constitutes a set of financial statements. So you're talking about the different components of financial statements. That hasn't changed much. We still have got the statement of financial performance, which can be referred to. Some use the statement of comprehensive income or statement of profit and loss and other comprehensive income. Those are still the terms that are still can be used in place of statement of financial performance. So that is still okay. Secondly is the statement of financial position, which, like I said, some use the term the balance sheet. So that's still fine. A statement of changes in equity, statement of cash flows, and then notes to the financial statements. And then obviously when you present your financial statements, you present them with comparative information. And then there are going to be instances where you need to present the third balance sheet, like in instances where you've done maybe a change in accounting policy and you need to show information at the beginning of the previous period. I think some of you, as you are reporting, particularly around change in presentation currency, for those that use presentation currency, which is the ZIG, you then needed to show a third balance sheet because of that change in accounting, because of that change in accounting policy. So these are the components of what makes up a set of financial statements, largely the same with what we had under IS1. So I'll really go into detail so that you've got an appreciation of what are the key changes. So when you look at financial statements, the standard makes a distinction which was not there in IS1 between what we call primary financial statements and the notes. Whilst we had exactly the same things, but we never looked at this with these lists, that these are my primary financials and these are the notes. And in that case, you're able to say what role and what purpose does my note serve? Because the word primary means this is the main place in which we go to look for certain information, because that's the primary financial statements. And then the notes is where you're going to go to get additional information. So essentially, we are talking that the primary financial statements is essentially a structured summary of transactions and balances. So we're talking about a structured summary of the entity's income, expenses, you're talking about your assets, your liabilities, your cash flows, your equity, and the likes in a summarized way, which allows people to get a high-level overview of the performance of the company. in a way. So the structured, so this is, like we're saying, this is a structured summary of the transactions and balances. It allows us to compare, it allows us to get a high level overview of what's happening in the business, how is management discharged on this stewardship responsibility. But because you want to communicate key things, it becomes summarized so that you're not cluttering with a lot of information. And that is where the notes then come in, which then provides details in a disaggregated manner with explanations. And that helps us have context to the financial statements. So the primary financials and the notes all play a very important role in communicating information about the financial information about the entity. But the two serve different roles. In the primary set, I just want to quickly understand how is the entity performed? What are the assets? What are the liabilities? Without being cluttered by too much information. Whereas if I then want to get into more detail on the information, I then go to them and then go to the notes. So they serve a very important, these two serve a very important purpose as we present financial information. So the standard then says when you're aggregating, I think we're starting that you have probably a lot more disaggregated, detailed information when you print your trial balance. But you're not just going to put everything on the trial balance on your financial statements. What do? You begin to aggregate similar items. Like you're not going to present in your financial statements and you say, I've got Tel 1 expense, I've got Econet expense, I've got Telecel expense, I've got liquid expense. All this can be aggregated and you can communicate that using one term because they're essentially the same. However, you cannot use aggregation for obscuring material information. So when something is material on its own and helps users understand that phenomenon better, the standard requires it to be disaggregated. Okay, just trying to see what happened to my presentation here. Okay, that's fine. So apologies for that. Let me go back to sharing my screen. Okay, we should be good now. Apologies for that. Right, so we're talking about aggregation. We shouldn't use the need and the desire to aggregate information by then obscuring, using that to hide information. That's why, for example, you can't, if you've got a significant impairment, it's going to affect the way the users, they want to understand more. So when you then bunch it up with a lot of other things, users are not able to see that. So you then might have to present your impairment expense separately so that users can see that. That's just an example. So let's come now to detail in terms of where the changes are and how does that affect the way you present your financial statements. So for starters, you've got 5 mandatory categories that you must show on your statement of profit or loss, right? So 5 mandatory categories. We didn't have this in IS1. So this is being brought because of IFRS 18. And it helps with consistency in understanding and interpreting the information better. And what we are seeing is that it is almost borrowed from the way we used to do or the way we actually do cash flow statements where you separate your cash flows between the operating, investing, and financing activities. So that is the same sort of concept that has been brought into the way we present our statement of profit or loss. So you've got the first category being the operating category. And then you've got the second category being the investing category, financing category, income taxes, discontinued operations. And I'll also talk about entities we have got specific rules. So on the operating category, so it's easy to deal with everything else and then finish off with the operating category. So in the investing category, this is where you're including income and expenses that have been generated by assets independently or independent of the operations of the business. So, for example, if you are a manufacturing concern, but you then have a real estate investment. So you've got a building that you are that is an investment property, and you're getting rentals from that. So that asset is generating income and it's got expenses independent of the main operations. So what it means is the income related to that investment and the expenses related to that investment are now shown in investing category of the statement of profit or loss. So if you've got things like investments in associate and you're getting a share of profit from the investment in associate, you've got joint ventures. So all those things that would ordinarily be seen in a business as investing activities that we are doing. And I emphasize that we're talking about doing this independent of the corporations of the business. And that automatically be what is investing activities. Then financing activities become the income and expense relating to raising of finance to finance the business. So you're talking about, for example, things like loans, or if you're using lease arrangement, financing lease arrangements, the financing around that becomes what you put under financing category. Then you obviously have got your income taxes. And then when you're in a period where you have a discontinued operations, where there's been a discontinued of certain operations, you can then disclose it separately in line with the way we disclose discontinued operations. So now, when you're coming back to the operating activities, when something that it's not an investing. So you've looked at this and you say it's not investing, it's not financing, it's not income taxes, it's not discontinued operations. It then goes into operating category. So I just want to emphasize here that because the risk is that if you define operating category specifically, which the standard standard avoided doing, you could end up with things that people say, I don't know where to put this. It doesn't seem like it's operating, it doesn't seem like it's investing, financing. And then we end up with sections other, you know. So in this case, you're testing and saying, is this an investing? Does this fit in investing category? Does this fit in financing category? Does it fit in income taxes and discontinued operations? If it doesn't, then you then put it in operating activities. So we haven't really defined operating, because I think sometimes people want to look at operating activities and say, what is the core of the business? What is the business into? So that becomes my operating activities. But companies have become extremely complex and the operations are diversified. So it's extremely difficult to say, so what constitutes the operating activities? So in that case, I'm looking at investing, I'm looking at financing, I'm looking at the income taxes and discontinued operations. Once I've put things there, anything else, all the other income and expenses that remain then automatically become go into the operating category. So the exception to this is, for example, you've got specific rules for entities with investing or financing as a main activity. So what you see, for example, for banks, typically you'd find that they are because they're in the business of lending. So typically what in another business could be financing could actually be operating for a bank, right? So what that means is, what that essentially means is that you can't look at this category in the same lens. So which means for a bank, the interest income and the interest expense, which ordinarily would have gone into financing, becomes the operating. So you'll see that in other entities, which are more investing entities, their investment income actually becomes operating income because of the nature of their business. Right, let's talk about subtotals in profit or loss. So subtotals, I think what is also coming in with the new standard is that the having a minimum defined subtotals, which must be there when you're presenting your financial statements. So when you're talking about subtotals, that must be seen is number one, your operating profit or loss. So remember, we spoke about the operating category. And then from the operating category, we must be able to see what is the operating profit or loss that the business was able to make out of that category. So that becomes a mandatory subtotal which must be shown as you're presenting your financial statements. And secondly, is your profit before in financing and income taxes. So what that means is if you take your operating profit or loss, and then you add what's coming out of the investing category, what you then have is profit before financing and income taxes. Then you can then have the financing category and the income tax category. And then you show your total profit or loss. Okay. Now, these are the mandatory subtotals which you must show in your statement of profit or loss, but entities could actually present additional subtotals if they believe they are useful. And I'm going to talk about where that comes in and what then do you need to do if you're showing up other subtotals in presenting your financial statements other than the mandatory required subtotals. And we're going to come to that in terms of what it is that you need to do. So presenting, this is by and large has remained the same. Remember on expenses, you must choose in terms of your presentation, whether you're going to present by nature. By nature, it talks to what what is, so the way I could like define the nature is you're describing what that expense is, right? So for example, by nature, that's what you are saying this money is for employee benefits, right? So you say employee benefits, it's depreciation and amortization, it's impairment, it's operating cost, something like that. That becomes by nature. But by function allows you to group because of what that money is trying to achieve, sort of. So by function, that's where you start having, where people start presenting, for example, cost of sales. So what do you have in cost of sales? You're aggregating within cost of sales. For example, you've got employee benefits related to maybe it's manufacturing, you've got depreciation in there, you've got purchases in there, and then you're just saying, but this is my cost of sales. That becomes by function. And we have got, sometimes you can have an expense like depreciation, not depreciation, sorry, administration expenses. So you're aggregating costs related to do with administration. That typically becomes by function. What I've seen in financials, because people don't have a good understanding of trying to distinguish what is nature and what is function, people mix it within the same presentation structure. So you must decide whether you're going to do by nature or by function. And the standard is now additional guidance that allows us to quickly be clear in terms of what is by nature and what is by function. But however, if you have done by function, you must still disclose, obviously, in the notes, the depreciation, amortization, employee benefits. These additional disclosures become mandatory to be disclosed. Statement of financial position has largely remained the same with additional clarifications, particularly around current and non-current classifications. Sometimes people struggle in terms of, is this a current asset or is this a non-current, assets? The structure that financial institutions follow, which is based on liquidity, is still fine. So nothing much is really changed for this particular section. It's really more to do with just clarifications to help understand the financial statement. Statement of changes in equity, just nothing much here, just still the same, and additional just clarifications and just making it more clearer so that users can understand it better. Remember other comprehensive income. Other comprehensive income. You're talking around items that are classified to profit and loss. These are the things that initially you're putting in, depending on the policy that you have, things that you could reclassify to profit and loss, or items that are not reclassified. I think there's always been lack of clarity around what really goes into other comprehensive income, and also which items do I reclassify to profit and loss and which items do I not reclassify to profit and loss. So that additional guidance is there. Now let's go to the notes. The notes, basis of preparation. Now with more guidance around how you disclose your basis of preparation, how you disclose your accounting policies, including other IFRS. Now, other IFRS disclosure requirements are really based on other standards as well as other material material information. So now let's talk about management-defined performance measures. So I spoke earlier about the mandatory subtotals that you need to present when you're presenting your financial statements. But then in some instances, management may want to show additional information within the structure of the financial statements as a way of communicating additional information. So they are showing a subtotal, which is not a subtotal that is required. And then so once they show those additional subtotals, we then, because they're trying to convey certain a way of looking at the business. So what we are then calling that management defined performance measures, right? So you've got subtotals that are used publicly outside financial statements, and they reflect management's view of performance. So an example, entities sometimes show them, we have got things like EBITDA, right? Earnings before depreciation, tax, and amortization. That becomes like a management defined performance objective, because by the nature of their business, it's a number that is probably very important to them for them to be able to show it. Entities could show a number like gross profit. For certain companies, gross profit is not a required subtotal. But by nature of your business, you think gross profit conveys certain information which users must understand. So you're incorporating gross profit within the structure of your statement of profit or loss. That gross profit becomes a management-defined performance measure. So in terms of when you're disclosing, it's important then that you must communicate what is that measure and what purpose does it serve, something that we didn't have, because sometimes people, like as accountants, sometimes we take it for granted that the users understand everything because maybe we've been taught this from college and all. But we must understand that it's important that if we're introducing something in our financials, we need to communicate to the users to have an understanding of what that is. So you must have definition and what purpose, including a calculation method. How is this calculated? Now, remember, we've got a predefined structure. So when you then go and show a certain structure, people must be able to relate it back to the numbers that are being disclosed in the IFRS figures, including then obviously disclosing the any tax or non-controlling interest effects of that particular defined measure. That must be disclosed. Right. Issues to do with capital disclosures. It's objectives and policies and process for managing capital. Quantitative data around the capital, including if there are any external capital requirements. Normally, for regulated entities, there could be an external requirement of capital, as well as are we in compliant, or if we're not compliant, what is the consequence of that compliant? So the additional guidance around disclosures around capital as well, which is being brought about by the standard. So when you get the slide, when we share with you this information, one of the things that you're going to get as well is just the summary, which just contrasts IFRS 18 and IS 1, so that you've got a quick look and saying what is the main difference between these two different standards. So what I've done today is essentially just to give you a high-level overview for you just to have a basic understanding of what IFRS 18 is bringing about. I haven't really done enough justice because of the time limitation we have. So one of the things that my colleague is going to come and talk to is really because we've got an upcoming workshop which whom I'll give you more details on. But in this workshop, we're really going to go into more detail around these changes that I've spoken about, and be able to work through, for example, how do you remap your current financials into this new structure, or in some instance, going back to the TB. So we'll have practical examples of remapping your TB to the new financial statement structure, and be able to say, how am I going to start presenting? And we deal with how you're going to transition from what you're currently presenting and also just talk about what is the strategy that you need to have in place if you're going to as you transition into this new standard. So we'll have more time. And like we have today, to really then go into detail and make sure that every concept that we've spoken about, we are able to do examples, look at examples, look at case studies, so that you've got a comprehensive understanding of the new requirements that are being brought about by IFRS 18. So, but for now, it was just helping you have an appreciation of the standard, a high-level overview of the standard, what it is bringing, and what it is that you need to have an idea of. And we're going to share this material that we have. And I think, having said that, that brings me to the end of my presentation. And then I'll hand you over back to Emmanuel.
Okay, thank you very much, Elias. That was an insightful presentation. I'm sure we all agree we are now in a better appreciate the changes to the profit and loss statement. Now moving on to our second presentation, which will be presented by our head of marketing, Wilma Kombe. Over to you, Wilma.
Thank you so much, Emmanuel. Just to confirm, you can see my screen.
Yes, we can see your screen.
All right. Good morning, everyone, and thank you for joining us for this webinar. So I'm going to take you through about LCHAT Business School. So my name is Wilma Kombe, as alluded by Emmanuel, and I'm currently the head of marketing and business development for LCHAT Business School. So under LCHAT, we've got two companies, one which is the LCHAT Business School, and here we offer the professional education and trainings. So under professional education, we've got the public sector professional accountant program, which is abbreviated PSPAZ. So this program is a 3-year program that we offer in collaboration with the Institute of Chartered Accountants of Zimbabwe, which is abbreviated ICAZ. So this year program takes you through from level 1, level 2, up until level 3. And your main modules that you'll be studying are your audit, taxation, public financial management, financial reporting, corporate governance, and public policy. So for 2026 applications, they'll be open in August. So for those who be interested or know anyone who might want to join the program, please feel free to get in touch with us. Our second program that we offer is the Association of Chartered Certified Accountants, which is abbreviated ACCA, also known as ACA. So for this program, we're offering a structured program, and our main target are the students coming straight out of A-level, where we take them through the journey, which will be a 2-year course for them up to fill their professional qualification. For us, they'll enroll with us and we'll hand-hold them all throughout their journey, us being the tuition provider for them. They'll also register the exams with the ACCA board. Over and above the professional education, we've got the learning media. So under learning media, we have various intellectual materials that we sell. We've got IFRS standards, we've got IPSA standards, we've got technical guidance and technical legislation handbooks that will help accountants in the public and both private sector to help their job better. Under trainings, we've got organized workshops and in-house trainings. So for organized workshops, we then organize a workshop, then we actually call out to entities who are interested to come to these workshops. And our workshops that we've done in the past, we've done on IPSAS implementation, financial statements preparation, asset management, financial instruments and leases, IFRS and sustainability standards. We also do Microsoft Excel, data analytics, AI, and Excel for financial model, and over and above report writing. So these are some of the workshops that we do as organized. For in-house trainings, we're saying if entities then require specific attention or specific needs, they contact us, we give them a quote, and we come to you to assist you in any way that you see fit pertaining the accounting or financial statements issues. And that's for LCHAT Business School. Then we move on to LCHAT Chartered Accountants, which is abbreviated ACA. So for ECA, we do audit and assurance, that is your statutory audits and internal audits, your accounting and financial reporting, both IFRS and IPSAS compliance, and also outsourced accounting. We also do tax and corporate finance, this is your tax planning, transaction advisory, and valuations, and also do ESG and advisory services, where we are now dwelling into the issue of sustainability reporting, internal control reviews, and governance consulting. We also do training and thought leadership through the collaboration with the LTED Business School, including CPD workshops and client training. So under ECA, the LTED Chartered Accountants also do talent outsourcing, where we are saying we've got trainees and assistants to help you in your business period to do the reconciliation, either your bank reconciliations, your creditors reconciliations, or your debtors reconciliation as you prepare for your audits. So please also get in touch with us if you need any assistance during the busy period. Now, as I talk about our upcoming workshop, we have an upcoming workshop for IFRS. This will be the theme Navigating Complexity, where we'll discuss hyperinflationary currency transition and ESG. And the key highlights, like alluded earlier on, we've got issues of practical guidance for hyperinflation, new and amended standards, and also fair value measurement in challenging market conditions, and also talk about sustainability and climate disclosures. And over and above, we cannot get away from issue of technology, the use of data analytics and AI to enhance reporting and compliance, and just the regulatory outlook and local adaptation strategies. So please come to our workshop where you get much more detail into these discussions. For our investment packages, we've got packages for conference only, which will be $400. Then another option where you can get a digital corporate tablet. So this tablet will be preloaded with IFRS standards and it's going for $580. We've got a package again with conference. There's conference plus accommodation. Then a full package that encompasses the tablet that will upload the standards. But then if you require a specific tablet, we're also free to negotiate and then we can arrange one for you. Then for our venue and dates, our venue will be Tamarind Holiday Conference Resort, that will be in Nyanga. And our dates are 22 to 24 July, traveling dates being Monday the 21st and Wednesday the 24th, 591-780, or you can email us at marketing@elchat.com. You can visit our website, www.elchat.com. Or if you care to do a physical visit, we're by Angwa City Building on 8th floor. Or all our social media pages, our handles are LChat Business School. We are on Facebook, LinkedIn, YouTube, we have a WhatsApp e-channel, and also an Instagram account and a TikTok account. Over and above all these, feel free to contact us for any requirement.
Thank you very much, Wilma, for your presentation. Okay, now we'll move on to our Q&A session. Okay, we'll start with the questions that are in the chat, then we'll move on to those who have questions they can ask directly. So the first one is, we will get the slides after the presentation. Okay, I will answer this one. Yes, we are going to circulate the slides as well as the recording after this session. Yes. Then moving on to our second question is, how should mixed items, e.g. foreign exchange gains or losses, interest income, be classified?
When you're talking about your foreign exchange gains and losses, the question that you need to ask yourself initially is that where is that foreign exchange gain arising from? So, for example, if it's a foreign exchange gain or loss that is arising out of your financing, it means it goes together with financing. If it's arising out of your investing activities, your investing category, it then goes in the same thing if it's also arising out of your operating category. So that's sort of the principle that you sort of need to follow as it relates to where you classify some of these mixed items. Yeah, thank you.
Okay, thank you. Then the second question is, how does IFRS 18 affect comparability between entities across industries?
So I think one of the things, if you're going to compare IS1 and IFRS 18, it actually has brought entities in a place where it's actually more comparable. Number one, because of you're able to actually assess even entities that are in different industries. Because the numbers you're looking for is, for example, your operating profit and or operating profit or loss. So whether you're in retail or whether in manufacturing or whether in other industry, this talks to that the business model itself is delivering profit, right? The investing activities you're saying, whether whatever industry, depending on what entity is done in the past, particularly in IS1, I think I'm getting some disturbance there, right? Okay. In IS1, you couldn't tell where the money is coming from. And because of that, it would make it very difficult to actually compare between entities in different, even in different industry. So I actually think just this change and the mandatory subtotals could actually help you compare even entities that are in tourism, in hospitality, and a company that is in manufacturing, because you're able to assess their operations, you're able to assess their investing, you're able to assess their financing, which was not something that was coming clear under IS1.
Okay, thank you. Then the next question is, will IFRS 18 become a de facto standard for performance reporting across the globe, even in jurisdiction that still allow local gaps?
So remember, IFRS adoption is the first thing. So if a jurisdiction is adopted IFRS, automatically IFRS 18 becomes applicable, which has actually happened. I think you have got very few jurisdictions where IFRS has not been adopted as a standard. So the expectation in terms of global use is quite high. I think that is the expectation that we have, that it will be used globally, as long as the country, at a country level, IFRS is a prerequisite standard. Yeah.
Thank you. Then moving on to the next question, said, hi there, is there online option for the upcoming workshop for those who cannot attend physically?
So currently for this upcoming workshop, it's a physical workshop, but we are looking into organizing an online workshop where all participants can join. So we'll do get your details. Then once we've got a date set, I will then contact you.
Okay, thank you. Then the next question, does this carry few CPD points?
For this particular session,
So for
I
the
think
organized workshop, yes,
answer.
that is CPD hours, but for this webinar, we don't have any CPD hours allocated.
Okay, thank you for that. Then we also have another compliment, insightful presentation. Thank you so much. Then another question said, does IFRS 18 have an equivalent standard with IPSAS? While it is true public sector is its own standard, can public sector entities benefit from the benefits of IFRS 18?
Okay, so that's a very interesting question. And so number one, whenever there's a change in IFRS, one of the things that the IPSAS always do is to look at the standard and look at whether they need to update IPSAS 1 to incorporate some of the changes in IFRS 18. So that process will probably going to happen maybe in the next 3 to 4 years, where they look at the updates to, which is the changes, because right now IPSAS 1 is based on IS1. So with this new change, they're going to have to look at IFRS 18. But like I said, to the extent to which entities would like to use it to improve their presentation, I think it's important that entities understand, like the statement I said from the start, that the overarching objective, the overarching scope is for profit entities. So the structure is trying to talk more to an investor. It's trying to talk more to someone who wants to assess, because when you look at most of the changes, it's affecting the statement of profit or loss, which is where the interest around profitability and all becomes a key issue. So we'd still wait to see what IPSAS B changes. Are they going to go through the same process and format, or because in the public sector, the profit objective is not as in the private sector. Yeah.
All right, thank you so much, Alice. So I'd like to do a poll. So please note, we're going to run a poll, and for someone who gets all answers correct, we're going to do a giveaway. So you contact us via inbox. So over to you, Emmanuel. Out. Are there any other questions? Anyone who wants to ask something, please feel free.
Hi, Wilma. Wilma,
Afternoon, Mr. Kofu.
Yes, good afternoon. So my question goes to Alice, maybe just for clarity. Under financing section, there's a line for interest expense on pension liability and provisions. I want to understand what's the standard trying to achieve by isolating pension liabilities and in provisions under that section, because I'm also comfortable with the first line, which is interest for borrowings and leases liabilities. But maybe I just need some assistance how and what is the standard trying to achieve by isolating pension liabilities and provisions. Thank you.
Okay, no, that's fine. Thank you very much. So typically when you have got pension liabilities in your balance sheet, remember you're going to amortize or unwind them, right? So as you're unwinding your because these are long-term liabilities. So what happens is as it unwinds or as it amortizes, there's going to be an interest related to that particular liability, all right? So what that essentially means is that interest becomes a financing cost to the business. So typically it becomes like when you unwind it, there's going to be a financing element to that. So that financing element is what we are then taking into the financing section, because as it relates to pension liabilities and all, you're not putting it as part of your operating category or your investing category, because it represents a liability on the balance sheet. The same thing applies with provisions. Sometimes you've got things like your long-term provisions. It could be to do with provisions for rehabilitation, provisions for those long-term liabilities. Again, they unwind every year, because what happens is when you've determined the provision, let's say 10 years from now, you present value it, and every year what you're going to increase that provision, which we call unwinding. And as you unwind it, it essentially means that it's going to go into there's going to be an interest cost around it, and that interest cost we put it under financing. So we have there could be more loans and borrowing, so it's all under financing. I hope that helps.
Thanks, Alice. Well noted.
Wilma and Emmanuel.
So you were reading the other question that was put on the chat system. So the question reads, should entities communicate the rationale for reclassifications or new disaggregations to stakeholders?
So I think it's part of the transition process, because as you are transitioning, remember every time you've got a new standard that's coming in, it changes the way you're doing things before. So it's a change in accounting policy. In this case, you're changing things within your financial statements. So one of the key things is they are going to then do disclosures related to this new standard, so that you communicate what it is that has changed. But at the same time, remember, we're going to restate even what we had in the prior year, so that people can actually also look at last year and be able, because we would have reported using a different format for 2026. And then when you do 2027, we then change that 2026. So people can actually compare how things have changed between the two standards, so that appreciation would be there. But in terms of disclosures, they are already disclosure requirements around the changes you have made as you implemented the new standards which are provided for in the standard. Thank you.
Thank you, Alice. I hope you were answered on that question for those who had asked for. So I've seen also some people are asking what was the answer to number 4. Emmanuel, what was the answer to number 4? And some saying I only saw question 1 and 2. Some also saying only got 2 answers. So also share these answers and the questions. We've now popped them up on the screen. I hope you're able to see them for those who are asking the answers. So just going to run through all the answers again. Okay, you've seen it. Thank you so much, Mr. Rugonye. Then there's another question which says, what did Wilma say to those who get all the correct answers? So for everyone who got all the answers correct, you're getting an Elchard branded t-shirt. So please inbox us for your size, then we'll advise you when you can come and collect. The number to use is 0781 591 780. I'll repeat the number, 0781 591 780. I see there are no other questions. I'll hand over to Emmanuel. Emmanuel, over to you.
Okay, thank you very much, everyone, for attending to this webinar. And thank you to our presenters for such an insightful presentation. As we said, we circulated the slides as well as the recording to everyone, and also on our social media handles as well as our YouTube. So thank you very much. Have a good day.
Thank you.